Enam Holdings, who's joining us right here in the studio. Sridhar, Happy New Year to you, and hope this year is filled with not just health, wealth, but a lot of travel for you.
Yes.
To newer destinations, to richer
Happy
forests.
New Year to everybody.
And better sightings as well for you.
I was going to say that.
I don't care about sightings. As long as I'm in the jungle, I'm always happy. I get new ideas there.
So you're back from a jungle now. Tell us, what are
Yes.
the new ideas for 2023?
Well, the idea is not to have FOMO and just stay put. Our view for 22 was it's a tough year. I don't think it's changed much for 23. That macroeconomic data still not looking very favorable for a global bull market. So this is going to be another challenging year. Like we saw in 22, we'll see a lot of ups and downs, at least for the first 6 months. That's our view, at least that's my view. That's better to protect capital again in the first 6 months and take a call post that.
You know, it's at such times that alpha managers become important because it's not
It
going
does.
to be a top-down market.
So
We have
actually, last year was a great year if you had the right stocks. And fortunately for us, we were more in the value camp than on the growth camp getting into 22. And we thought that, end of 21 was like the peak of growth. Buy anything, PE to concept and PE to some nonsense. Just couldn't understand, and I had seen all this in 2000.
Yes.
And I could actually see a repeat of that in front of me. So fortunately, the mistakes I made in 2000, I didn't make in 21 and 22. So the experience of managing money over a period did help. But I think a lot of the froth is out. But does it mean that, the macroeconomic environment looks great? It doesn't. But there is opportunity to make money. So there are pockets where you can still make money. But you have to tread carefully. You have to be sure that earnings growth or your outlook on the earnings on these stocks are good. And there are some margin for error, but if your margin for error is very high, markets punish very fast, as we've seen.
All right, Sridhar, let's focus on the two pillars of the market then. Banks, which you have been positive on,
Sure.
but some of them have seen a big run. So
Yeah.
what's your view for 2023? And IT, that's the other pillar that's been sulking. After having a very, very good 2021, we did see a bit of a downtake. Have they come to levels that you like to get in, or do you believe still stay away? There'll be a deeper correction coming in there.
So on the financials, our view remains that it's possibly on a sweet spot right now. Big bankers like Mr. Uday Kotak said it's a Cinderella moment, and I don't dispute that, because it's not just the loan growth. Actually, the bigger delta is the credit cost. When you speak to people in the banking sector, they tell you that it's not only the corporate sector which is not seeing the credit cost, even the retail, for whatever reason, strangely enough. In fact, our view is there's a K-shaped recovery. We should see retail NPAs coming through, because if the lower half is not, participating in the growth, then there should be NPAs there. But strangely enough, the bankers are telling us that even the NPAs in the retail segment are much lower than what they have modeled in their, books based on their assessment. And so they keep telling us, don't go with the credit cost we saw in the first 6 months. It'll be higher, but we're not seeing follow through of that. So whatever it is, I really don't have an exact answer. We think credit cost is going to be significantly lower. As a result, the earnings growth for banks will be significantly higher. As a result, we will see upgrades in financials. Maybe possibly the only sector where we think there is chance of an upgrade. In fact, we think there'll be downgrade opportunity or downgrade possibility in most of the sectors. So as a result, there could be earnings cut, but in financials, we're very bullish, not only in the private sector, even on the PSU. We've been champions of PSU banks almost for 2 years now. A lot of it is played out, but we think that a lot more will play out.
You're taking away my next question. Exactly that. Everyone's got ICICI and HDFC Bank and maybe even SBI. Lower down, we saw a spate of buys on BOB, and even PNB started coming in. Would you go still lower in the PSU list and all private sector banks?
So Lata, I think what is happening is basically exactly what I said. The credit cost is lower. Mistakes the banks have made in the past 2-3 years are much lesser. So you have a Cinderella moment, almost as a rising tide takes all boats up. We would prefer to stay in select few PSU banks where we have more comfort, or maybe a few second rung banks. Is there opportunity in other banks when the the macro tailwind is so positive? I think a lot of the banks will do well. In fact, in one of your earlier shows I had mentioned that just as a retail investor, you just buy a banking, fund.
Yeah.
That's it. You don't need to worry about which bank, what bank.
You know, I remember, I think this was 2 years ago, we did a show on our Smart Money segment where I was talking to you about themes, and that time PSU banks were out of favor completely.
Yeah.
And I asked you repeatedly, are you sure you want to go with this theme? And you said, yes, I'm dead sure. And, I mean, kudos to you for, sticking your neck out
Sonia,
at that time.
I'll tell you exactly the story that happened. I mean, this was November of 2020, and one of the investment bankers pushed us to a meeting with one of the PSU banks. And I said, I'm not going to buy PSU banks, so don't even offer me the meeting. They insisted, no, chairman is there, why don't you please meet? And it was a Zoom meet anyway, so it didn't matter. And as the meeting progressed, we realized that their pre-provision profit is larger than the market cap. So we said something is seriously wrong. So then we started looking at the other banks, and that's how this actually played out. And then we realized that there is a big story playing out. What happened after that, a lot of it is also that the macro environment has been favorable. We wouldn't have expected it to be so favorable. As I said, credit cost is much lower. I really don't have an answer for that, but it is much lower. So I think I stick to that theme right now.
Another theme I just wanted to ask you about, because it is the theme of the moment on the downside, is these new age tech companies, right?
Yeah.
I mean, we're seeing a spate of large exits at names like Zomato. But the other way to look at it is profitability is improving, metrics are improving, and now the old guard is sort of moving out and fresh blood coming in. Would you read that as a good sign?
So I think we're starting to engage with a lot of these companies because a lot of the froth is out. We think growth will come back maybe in the second half. So we need to be ready with our analysis on which are the good companies and what is the right price to enter some of them. What is the business model? Do they have a path to profitability? If a lot of this fits in, I'm not against any of the new age companies. Some of them are really good companies. Question is, what is the price we are paying for it? And I go back to my 2000 learning that Infosys and Wipro were trading at 50 times revenue. They were not bad companies. They were great companies. In fact, Z even today is lower than the price it was in 2000. So does it mean that Z was a bad company? No, we priced it wrongly. So that's the point, that these are great companies. Is the pricing right? In our view, no. Some of them are reaching the price. So we are still analyzing those. So I'm not against any of these. These are good companies, wrongly priced in 2022. Surely some of them are reaching good price levels.
All right. Sridhar, besides equity, suddenly we're talking about, fixed income. You're seeing yields go up there. They're becoming a little bit more attractive as well, which could be a risk to the flows that are coming into the equity markets. I wanted your view. There'll be a lot of our audience out there. They're looking to construct their portfolio. What should the asset allocation be? What about gold? Suddenly that started shining a little bit. Your take?
Yeah, so I'm a big bull on gold. And I've constantly told people that, you should not look at the
Indian woman is the cleverest.
Yes,
I got that.
and I have stated that on Twitter, on my LinkedIn profile, that the best fund manager is the Indian woman, because gold has outperformed not only in the short term, in the medium term, even in the long term, the Sensex. So the Indian woman has shown, despite, a lot of people saying don't buy gold, our current account deficit is going up, it's a dead asset. But people fail to, realize that it's a hedge against the currency.
But let me tell you that the Indian woman is also changing. There are two sitting here and both don't believe in buying gold. So,
well, so there will...
because we have sons.
There will be exceptions.
As an investment,
but there will be exceptions. But majority of Indian women, especially women in the rural areas, the easiest thing for them to invest is gold, and they've been investing for years. But let's cut this. The net result is that gold has given double-digit returns, even if you take 15 years, 20 years, and has outperformed the Sensex in most of the periods. There are periods where Sensex has outperformed gold. But the point is in asset allocation, as you mentioned. In my view, 5 to 10% of your assets should be in gold, not because gold will outperform anything. It's just another asset class.
Yeah.
Plus, it's a hedge against the currency. If the currency depreciates 3-4% every year, the gold will give you that return anyway.
Sridhar, I'm actually following...
Just on asset allocation, when interest rates were rising 2004 to 2008, the market was also rising. And Greenspan told us that, accommodation will be removed at a modest pace. We knew those rate hikes were coming, but the markets kept rising. So is this rising rate such a big deal?
So, Lata,